Welcome to Understanding Money Made Easy. Have you ever wondered how investors make money from owning stocks, even when they don't sell them? The answer lies in something called a dividend. Let's break down what a dividend is and how it works. When a company earns a profit, it has two main choices. It can either reinvest that money to grow the business, like launching new products or expanding operations, or it can share part of those profits with shareholders. That shared portion is called a dividend. Dividends usually come in two main forms: dollar note cash dividends, which are paid directly into your brokerage account, and upward trend stock dividends, where you receive extra shares instead of cash. Sometimes, companies even issue special dividends as a one-time bonus when profits are higher than usual. To understand how dividends are paid, you need to know four important dates. Declaration date, when the company announces the dividend. Ex-dividend date. If you buy the stock on or after this date, you won't receive the upcoming dividend. Record date. The company checks who's eligible. Payment date. When the dividend actually hits your account. So how can you measure how much a company pays out in dividends? That's where the dividend yield comes in. It's calculated like this: annual dividend per share divided by stock price per share. For example, if a company's stock is $100 and it pays $4 per share each year, the dividend yield is 4%. Dividends are great because they can provide a steady stream of income, especially for long-term investors or retirees. And if you reinvest your dividends, through a dividend reinvestment plan, or DRIP, you can buy more shares automatically, helping your investments grow faster through compounding. But keep in mind, not every company pays dividends. Fast-growing companies often reinvest their profits instead. And if a company suddenly cuts its dividend, that might be a sign of financial trouble. Also, remember that dividends are usually taxable income, depending on where you live. Want to make $100,000 a year in passive income just from dividends? Let's break down exactly how that works using a real example. Let's say you're looking at a stock that pays a 3.5% dividend yield, and each share costs $100. That means for every $100 you invest, you'll earn 3.5%, or $3.50 per year, in dividend payments. So if one share pays $3.50 a year, how many shares would you need to earn $100,000 annually? Abacus, let's do the math. $100,000 divided by $3.50 equals 28,571 shares, approximately. That means you'd need to own about 28,571 shares of that stock. While this sounds overwhelming, the stock market isn't necessarily a get-rich-quick scheme. It's meant to establish long-term wealth over the course of a life. And since each share costs $100, your total investment would be 28,571 times $100 equals $2,857,100. So, you'd need roughly $2.86 million invested in this stock to generate $100,000 per year in dividend income at a 3.5% yield. Now, that's a lot of money, but here's the thing. The required investment changes depending on the dividend yield. At 5% yield, you'd need $2 million. At 4% yield, about $2.5 million. At 3% yield, around $3.33 million. And remember, if you reinvest your dividends instead of spending them, you can accelerate your returns through compounding. Over time, that means you'll need less initial money to eventually reach that $100,000 goal. Of course, you wouldn't put all your money in just one stock. Most investors build a dividend portfolio, a mix of reliable, income-paying companies, REITs, or ETFs, to balance risk and return. So there you have it. To make $100,000 a year in dividends at a 3.5% yield, you'd need around $2.86 million invested. But with consistent investing, reinvesting dividends, and choosing the right stocks, that goal might be more achievable than you think. Start small, stay consistent, let time do the heavy lifting. So, to sum it up, dividends are the company's way of saying thank you to investors for believing in their business. They're a reliable way to earn passive income and can play a huge role in your long-term investing success. Thank you for watching today. Like and subscribe for more videos explaining money.